Good day, guys. With our newest video, get ready to controversy surrounding the Pi Network interest rate roadmap navigating towards mainnet stability. Pi Network is a decentralized cryptocurrency project that aims to create a digital currency for everyday use. It was developed by a team of Stanford graduates and has gained attention for its unique approach to mining and distribution. Users can mine Pi cryptocurrency on their smartphones, contributing to the security and operation of the network. Pi Network emphasizes accessibility and inclusivity, allowing participation from a broad spectrum of users. While still in development, Pi Network has attracted a sizable community of users interested in its vision of a decentralized and user-friendly digital currency. What is an interest rate? A percentage charged by a lender to a borrower for the use of an asset, expressed as a percentage of the principal amount the original sum borrowed. Acts as compensation for the lender for taking on the risk of lending the money or asset and for the opportunity cost of not being able to use the funds themselves. How interest rates work. Borrowing: when you borrow, the interest rate determines how much you'll pay on top of the principal. Saving: when you save or invest, the interest rate determines the return on your deposited money. Example: simple interest, principal interest rate time total interest paid. Types of interest rates: fixed interest rate, the interest rate stays the same for the entire loan or savings term. Variable interest rate can fluctuate over time based on market conditions or a specified benchmark. Nominal interest rate, the stated rate of interest before inflation is taken into account. Real interest rate, the interest rate after adjusting for inflation, i.e., the change in your money's buying power. Annual percentage rate, APR, the standardized rate for loans, including fees and other costs, gives a more accurate picture of borrowing costs. Annual percentage yield, AP, the effective annual rate earned on savings or investments, considering the effect of compounding interest. Factors affecting interest rates. Inflation: rising inflation typically leads to higher interest rates. Economic conditions. Strong economies may have higher interest rates than weaker ones. Central bank policy: central banks like the Federal Reserve set key interest rates that influence the broader economy. Credit risk: riskier borrowers face higher interest rates. Supply and demand for funds: the interplay between the demand for loans and the supply of available funds for lending impacts rates. While the traditional concept of interest rates applies broadly to financial systems, there are few ways it could potentially become relevant to the Pi network in the future. Pi as a lending borrowing asset: if Pi gains enough value and becomes widely accepted, it could lead to the development of platforms where people lend or borrow Pi. In such platforms, interest rates would apply as part of the compensation for lending Pi. Pi-based DeFi projects: decentralized finance DeFi applications often involve lending, borrowing, and yield-generating protocols. If DeFi projects are built within the Pi network ecosystem, traditional interest rate mechanisms would naturally become a part of them. Staking and rewards. Some Pi projects might offer staking mechanisms where users lock up their Pi tokens to support the network and in return receive rewards. While not strictly the same as interest, the reward rates would be analogous to the concept. Important considerations. Pi is still developing. The Pi network is still in its early stages and its economic model is not fully defined. Whether these financial mechanisms will directly integrate with Pi remains to be seen. Focus on utility. The primary focus of Pi seems to be on building a large user base and developing a utility for the Pi cryptocurrency rather than purely being a financial investment tool. Potential future scenarios. It's conceivable that if Pi network achieves mainstream adoption, concepts like interest rates might become more integral to how it functions within a wider financial ecosystem. However, it's equally possible that Pi may develop unique economic mechanisms that differ from traditional interest-based models. Types of Pi network coin interest rate regulation. Pi network, a decentralized cryptocurrency project, has implemented various measures to regulate the interest rate of its native coin. These regulations have been introduced in 3 stages of development to ensure the stability and growth of the network. Let's explore the 3 types of interest rate regulation in Pi network. Early stage reward locking system. In the early stages of Pi network's development, the team recognized the importance of stabilizing the initial market. To achieve this, they implemented a reward locking system. This system ensures that the initial supply of Pi coins remains stable and prevents excessive inflation. By locking the rewards earned by users, the network maintains a controlled supply of coins, which helps establish a solid foundation for the market. The reward locking system has proven to be not only necessary but also effective in maintaining stability. However, due to the high cost associated with this system, it can only be sustained for a short period. Therefore, the team needed to devise a long-term solution to regulate the interest rate. Interest rate implementation. After 3 years of operation, the Pi network market still requires stabilization. To address this, the team introduced an interest rate mechanism. The interest rate serves as a tool to incentivize users to hold their Pi coins rather than sell them immediately. By offering an attractive interest rate, Pi network encourages users to retain their coins, which helps maintain a healthy balance between supply and demand. It is important to note that once Pi network transitions to its mainnet, the team will no longer have the ability to intervene in the interest rate. Therefore, resolving this issue before the mainnet launch is crucial. The interest rate implementation is a significant step towards achieving this goal. 3 stages of the growth process. To accurately set the interest rate, Pi Network's growth process is divided into 3 stages. The third stage, which occurs approximately 10 years later, is particularly crucial for determining the long-term indicator of interest rates. During the first stage, the early stage reward locking system plays a vital role in stabilizing the market. It sets the groundwork for the subsequent stages and ensures a controlled supply of Pi coins. The second stage introduces the interest rate mechanism to further stabilize the market. This stage aims to strike a balance between incentivizing users to hold their coins and maintaining a healthy circulation of Pi within the network. Finally, the third stage marks the period of stability, approximately 10 years into Pi Network's development. At this stage, the interest rate becomes a long-term indicator reflecting the network's maturity and sustainability. The interest rate set during this stage will have a lasting impact on the ecosystem and its participants. In conclusion, Pi Network has implemented 3 types of interest rate regulation to ensure the stability and growth of its native coin. The early stage reward locking system and the subsequent introduction of an interest rate mechanism have proven effective in maintaining a balanced market. The 3 stages of Pi Network's growth process, with the third stage being the period of stability, play a crucial role in accurately setting the long-term indicator of interest rates. These measures demonstrate Pi Network's commitment to creating a sustainable and thriving cryptocurrency ecosystem. Love you guys all, and support my channel by giving me a like, dropping me a comment, and subscribing to enjoy more existing updates.